Ever wondered how a balance sheet can help you run your business better? Well, let's dive into the basics. Picture a lemonade stand. A balance sheet for this business would include all the assets, which are things you own such as lemons, sugar, and the stand itself. But wait, there's more. We also have liabilities. These are the debts or obligations you owe. In our lemonade stand example, that would be the money owed to the grocery store for the lemons and sugar. Now subtract the liabilities from the assets, and voila, you have equity. This is the money left after paying off the grocery store. It represents the owner's claim on the assets of the business after all the debts have been paid. So the balance sheet basically tells you what you own, what you owe, and what's left for you. Pretty simple, right? Now, let's see how transactions affect your balance sheet. Imagine you're buying inventory on credit. This is a common move in business. You're essentially promising to pay the supplier at a later date. So, what happens on your balance sheet? Two things. Your assets, in this case inventory, increase. Simultaneously, your liabilities, specifically accounts payable, also increase. This is because you now owe money to your supplier. Next, let's say you're paying off a loan. Your liabilities decrease because the amount you owe is lessened. But so do your assets, as your cash or bank balance decreases. Lastly, let's consider earning revenue from sales. You've sold some of your inventory. Your assets decrease as your inventory is reduced. But your assets also increase as your cash or accounts receivable grows. Plus, your owner's equity, the value of your investment in the business, also increases because you've earned profit. Remember, every transaction has a dual effect on your balance sheet, so keep an eye on how your activities impact your financial health. So, how can a balance sheet help you run your business better? Imagine it as your business's health report. It's got your financial vitals all laid out. Firstly, it tells you about your liquidity. In simpler terms, it's your ability to pay the bills. If you've got more assets than liabilities, you're in a good spot. Secondly, it talks about leverage, or how much you're relying on borrowed money. It's like a seesaw. Too much debt can tip the balance, but a little can give you a lift. Lastly, it shows you your efficiency. Think of it as your profit per asset ratio. Are you making the most of what you have? If not, it might be time to rethink your strategy. So, a balance sheet isn't just a boring report. It's a treasure trove of insights that can help you make smarter business decisions.